In this video, I'll walk you through everything you need to know about trading with confidence. From the basics like market structures and time frames to my own complete strategy using supply and demand, moving averages, and of course, you're nothing without smart risk management, right? So, whether you're new or looking to sharpen your edge, well, this guide will take you from understanding the basics, the foundations, to eventually trade execution. So, let me tell you a little about myself. So I'm JaviFX, and as the FX suggests, I actually came from Forex. Now I used these concepts I'm about to teach you how to trade crypto. Now I used to trade Euro USD and Forex. That was my bread and butter. But now I like to trade majors like ETH, Bitcoin, or Solana, altcoins like Aave and Sui, up even until meme coins. If you guys remembered when meme coins were a thing, right? I was a trencher, and I was using the same concepts. So I'm saying any type of market, may it be even the indexes, right? S&P 500, Nasdaq, even gold. If you want to use the concepts I'm about to teach you, then you can use it in any financial market. So I'm now a pro trader for Velaris Trading, and I've caught multiple tops and bottoms while everyone didn't know what to do. Right? This is the importance of what I'm about to teach you. Everybody, they panic, they don't know what to do, but you and me will be able to know exactly when to strike and exactly when to exit. So these past 2 weeks alone, I've already gained 25% of my account. So imagine the remaining weeks during easy mode, right? We'll be able to possibly double. So let's begin. So what actually is the purpose of trading? So the first one is to make money. Obviously, that's why we're all here. To make money and to live off of it. Number two, to take control of your own time. Honestly, you're your own boss, right? We use trading as a way to escape the 8 to 5, the 9 to 5, right? The rat race. Because honestly, you only need, let's say, 1 hour or 2 hours of your time. You just mark out your charts, right? Just mark it out. You see what levels are good. And if there are no key levels to look at, if there's nothing, if the day isn't giving you anything, then 2 hours and you're out. You don't even have to trade every day. Sometimes you trade on Wednesday and the amount is already enough for you to take the whole week off. Or sometimes you trade Tuesday, Wednesday, and Thursday, right? Obviously, you don't 100% win. Let's say you win on Tuesday, you lose on Wednesday, and you win again on Thursday, and tell yourself, okay, I'm out. So sometimes it takes you 3 days out of the week and you're out, right? Number three, you avoid large amounts of drawdown instead of the popular term hodling, right? Or holding on for dear life, right? This is a very, very popular term. Everybody tells you, oh, don't worry, just hold. You know, it's gonna go up eventually, right? But are we going to take into account eventually? What is eventually? 2 years, 3 years of you being underwater? Do you really want that? Right? And tying in with number three is retaining full mental capacity, right? So if you're in drawdown, can you tell me 100% that you will still be at 100% mental capacity? Will you 100% tell me that you'll be able to execute at 100% performance, right? Because even me, even a pro trader, we can still, right? We can still get our emotions riled up if we're in drawdown, right? Let me explain 3 to 4 here. So I have here the Ethereum chart, right? So I won't get in full detail about the strategy, but when this is all over, you'll be able to trade this exact move. So let me bring out the price range. You'll be able to trade from here up to here. 67.6% of your move, 68% even. And, well, at the very least, around here. Let's say you were holding up until here and the trend tells you to get out at this level. So you'd have made 46%, right? And when things are looking good again, we're back in, holding that 71%. And at the very least, losing the trend here, this will be at around 44%. So now here's the thing. This is where if you were holding, let's say you had an entry here, which you will know how to enter from there, but at the later part of this video. So let's say you were holding up until here. You're at 71.86% at the top, right? Okay, great. So you've nailed your entry, good. You're in profits, good. However, it's still unrealized profits. Now, what if you were holding it way past the exit signal, right? What if? So now you're 71%. Wait, let me just remove this. Okay. Now your 71% is, guess what? It's all the way down to 20%, right? What happened? All of a sudden, price went down 30%. 30%. At this point, 30% in a span of a month, right? A span of a month. And you were holding this trade for a month and a week, and you forgot to take profits. Either you forgot to take profits or you just didn't want to. Because crypto Twitter, very notorious for telling you to buy the dip, right? Oh, just buy the dip. Don't worry about it. Oh, just buy the dip. It's fine. It's fine. Just buy the dip. Suddenly, your beautiful entry is now underwater, right? This is the difference between holding and trading, right? Let's say at this point, oh my God, I am down. Oh my God. I bought the dip. I bought the dip so many times. Now, suddenly, I'm underwater and I wish I took profits here, right? Clear signal for me to exit, and oh my God, I still held it. Because crypto Twitter, they're telling you just to hold forever. And oh, you sold the bottom? Oh, you're a bad trader. Oh, you sold the bottom? Oh my God, you're the worst, right? Even this, you can exit at this point. You can exit here for 63% gain. And guess what? They'll still shit on you for missing 5% of upside. And those exact same people are the ones that's gonna write this down, right? So let's be realistic. You held until here. You're holding forever until we see an exit, right? So right now, you're at 46 plus 41. That's roughly like 87%, right? You chose not to participate in this drawdown. So you waited 60 days for a signal to pop up. And it did. It actually did. And guess what? You'd be able to identify it as well. Boom, we're in. And guess what? Right? The strategy will tell you you'll be able to get out here at this key level, 20% gain, or at the very least, at the trend break again, which is at 11. So now here's the thing, right? here's the thing. Okay, the same strategy that gave us this is the same strategy that gave us this, right? Now let's say, again, you're looking at crypto Twitter and they're telling you, oh, just buy the dip. Hold until this is Ethereum, right? Hold until it's $10,000, right? Because that's a 3x from here, right? It's alt season, yada yada, right? And guess what? Suddenly, if you held all of this, you would have gotten stopped out, right? And suddenly price went down 28% in a span of 45 days, right? Again, this is what crypto Twitter will tell you to do. Okay? I bet you can relate. Oh, buy the dip. Oh, just buy the dip. Oh my god, don't worry about it. Just buy the dip. Don't worry, buy the dip. Buy the dip, don't worry about it. Okay? You guess what? Suddenly you were in profits and now you're underwater. Right? What if you didn't even have the money to buy this dip? What if this was you were banking on this trade to work out, right? And guess what? You hodled. You held on for dear life. When clearly, if you were a trader, you would have gotten in at a specific point. You had an invalidation at a specific point, and you also had a take profit at a specific point. That's something we advocate for, right? So, okay, you would have gotten stopped out if you held. Okay, and guess what? After this 28%, we go another 39%, 40%, right? So guess what? If you're holding this particular trade, you would have gotten stopped out, right? Everybody telling you to buy the dip, buy the dip, buy the dip, right? And when suddenly we get this pump, oh, don't even sell, guys. Don't even sell. We're going to $10,000. Don't even think about selling. Right? It's alt season. How dare you sell? How dare you take profits? Right? That's the mindset of the hodlers, right? The diamond hands. Oh my goodness. I've heard everything. I've heard all of the terms. That's how they get you, right? You're already in profits. You don't take profits, you round trip it. They give you a chance to exit again, and you round trip it, and suddenly you're underwater, right? Now here's the thing. If you were hodling instead of trading, you'd be holding for 180 days. What is that? 6 months? Half a year. Only for you to lose money, right? So, that's the purpose of trading. So let's say you went through this drawdown period, right? Can you tell me? You are at full mental capacity. Can you tell me? Honestly, can you for sure tell me that when the next opportunity comes, you'd be able to capitalize on easy mode? Don't get me wrong, this is easy mode. You just buy and, at the most basic, simple level, you buy when it gives you a signal and you exit when it gives you the exit signal. That's the very basic way of telling the strat, right? So, for example, you held through all of this drawdown. You didn't take profit. Are you going to tell me with 100% certainty that when this opportunity comes, you'll execute? Will you? Or will you tell yourself, oh my god, I'm out of money. I'm not buying the dip this time. I'm not, even if we're seeing signals, I'm not buying this time because I've held this long already, right? So the same thing. Here, at this point, right here, at this point, and you write it up here, at the very best, or at the very least, when you break this trend. Are you gonna tell me that after you getting stopped out after holding for 6 months, are you gonna tell me that you're gonna be able to execute when the opportunity comes? Right? Think about that. 50% of trading is strategy, and 50% is psychology. Right? There's no work around it. There's no escaping it. So, if you're not at full mental capacity, if you're not 100% in performance mode, how sure are you'll be able to capitalize when it's an easy mode, right? Because crypto has phases of easy mode and extremely hard mode, right? Easy mode, anybody can make money, right? But it takes a select few to be able to keep that money or take profits, right? So when it's easy mode, maybe you can ask me, right? Yo, Javi, people are telling me they're losing money on easy mode. Why is that? It's because of this. They hold forever and then eventually get stopped out. And then now they have PTSD for the next easy mode. And then again, they just give it all back. Right? So at this point, what now? It's down 60%, 64%. Right? You're now a community member of Ethereum. What now? And guess what? It gave you that exact same signal again over here. Gave us that exact same signal for upside. If we were lucky, this is a good key level to take profit from. We got it, right? Or if you were still holding it, you would have been able to exit here at the, moving average break. And guess what? You'd be able to get back in here to be able to ride this whole move, right? Trading, honestly, it's very simple. It's just we self-sabotage, right? So if you add all of this up, let's say you held this position for a year. Where would we be right now? Let's go to the daily, right? So from here to here, 532 days, you're only up 53%. When if you were actually trading, right? Trading and not hodling, avoiding large amounts of drawdown, retaining our full mental capacity, then add this up for me. 46 plus 41 plus 11 plus 41 plus 61 and plus ongoing right now 45%. Right? I don't know, that's like a 3x to me. But if you just held forever, that's just 56% gain. Alright? Very simple. That's actually the very basic reason, why we trade instead of hold. Right? Keep this in mind. If this resonates with you, or if this is the first time, for you to understand that this is what happens, then this is the first step to, being a successful trader. Okay. So, now that we got that out of the way, let's talk about the basics, the foundations. So, let's talk about candlestick anatomy. So here's what the others won't tell you, right? Candlesticks can just be candlesticks, right? It's just candle, just awaken a body. That's fine. What if I told you, just by looking at the wick alone, you'll be able to tell that there is a reversal coming, right? Pretty wild. And inversely, with just the body of a candle, you'll be able to tell about continuation, right? Let's get right into it. So let's find a coin here. Let's find some price action. Okay, here we are. Very, very basic here. Very, very basic. Over here, this is a candle. This is a wick. This is the body, right? Very, very basic. You should already know that. However, here's where things get quite interesting. Okay? So, we broke to the upside, okay, using this body. So when we do that, right, when you do that and you use the body, that means there's continuation for higher. And you do get that. Same thing here. We're making a higher high with the candle body, right? Very simple. Now, why did I choose this candle over this? Right? Where are my words? Okay, I'll just type it again. So, wick equals reversal, body equals continuation. Right? Stay with me here. So we first got that continuation. So when we close with the body, when we close with this body, that means there's continuation higher, right? Now, let's look at the wick. Here, we did not close with the body, just a wick. So what does that mean? It means a reversal, right? Not necessarily breaking structure, but we know that after seeing this candle alone, after seeing this wick, we'll be getting some kind of pullback or reversal. Same thing here. Guess what? This was not a body. This is not a body close, just a wick. Therefore, what did we see? A reversal, right? Very simple. Very simple. Now here's the same story. So what happened here? Was it a candle body close or a candle wick close? Right? I'll give you 5 seconds. 5, 4, 3, 2, 1. It's a wick. So what happens if there's a wick? Reversal. Okay? What happened? Reversal. It actually dumped like crazy, right? Reversal. Same thing here. Just a wick. Therefore, reversal. Right? Very simple. Very simple, but it's actually very powerful because without any strategy just yet, no strategy yet, just candlestick anatomy, you'll already be able to make some, intelligent guesses or like a thesis already before price plays out. Okay, so I showed you the upside. Now I'll show you the bottom. Right. So here's the thing. Did we close below? 3, 2, 1. Nope. Just a wick. So after that wick reversal down, we got a wick reversal up. Right? Very simple. Same thing here. What is this? Was this a close? Was this a close? Nope. Just wicks. And guess what? We gotta push up. Right? Very, very simple, but very powerful. So I want you guys to check it out by yourselves. You'll be able to see that every single move is powered by these two. If a wick only, and there's a reversal. If it's a body, right, then for sure we're getting a continuation. Okay? Now, let's move on. Let's talk about trading timeframes. Very good, right? Very good. So, now you might have heard, oh, you're a trader. So you trade like the 1 minute or the 5 minute, right? And an investor trades, let's say the weekly or the monthly, holds for years, 5 years, 10 years. But a trader, no, no, no. Only 1 minute, only 5 minutes, right? But that's just not true, right? That's not true. You call that a scalper. It's a type of trader, but it's not every single trader, right? Me personally, I trade the 1 hour or the 4 hour mostly, right? You call that swing trading, right? Okay, so let's get into it. 30 minutes and below, possibly a scalper, right? This is the 1 minute, 5 minute, in and out between, like, 2 hours, you're done. 3 hours, maybe. At most a day, honestly. At most. Next, we have the 1 hour to the 4 hour. This is a swing trader, right? Mostly swing. Now, this is my favorite. My personal favorite. Now, why is it my personal favorite? Right? Because if you're a scalper and you trade the very, very low time frames, then there's a high possibility of you to get swept out. That's just how it is. That's the risk, right? High frequency trading, sure. But there's also a bigger chance for you to get stopped out because of how volatile price can be, right? Simple. Now, why is the 1 hour to 4 hour my favorite time frame? Well, it helps you catch the meat of the move, right? While giving you a good entry and good stop loss, right? You don't get stopped out much, and you'll still be able to capitalize on the moves. And the last one is the daily to the 3 day to even the weekly. Now, these are, well, you could say position traders, right? Position traders where they really take quite a long time, 6 months or 3 months to actually play out. Even a year, honestly. Sometimes a year or two. This takes way too long for me. Me personally, I know some traders who are very successful trading these, where they have a very good entry and they hold it forever. Sometimes that's the most profitable for them, but for me, I like this. Some of my trades last a day, some last a week, some last even 2 weeks. But the agenda is the same. We make money, right? The only reason I don't like this is because it's too long and it gives me such a wide stop loss, right? Because, at the high time frame, it takes quite a while to play out. So, okay. Now you know the time frames. Let's talk about the bread and butter, right? The bread and butter of our strategy. Market structures, right? This is what every single strategy is reliant on, right? This is the foundation of every single strategy. You can forgo everything, but you cannot forgo market structures. This is the most important strategy in any in any concept. You need market structures. Now, what are you talking about? What am I talking about? Okay, so we're talking about higher highs, so let's say there was some structure here already. Higher high, higher low, higher high, higher low, higher high. Oops, you broke down. What is this? Lower low, lower high, and lower low. Okay? Kinda simple, right? But what if I tell you, right, that most of the traders, this is where they mess up. This is where they mess up. Some of my mentees, they know the strat, they know everything, but this is where, they mess up. Because it's not as simple as you think. Okay? So, I'll give you my secret sauce. Assumptions. Right? Now, what the hell are you talking about, Javi? What the hell are you talking about? Assumptions? Okay. Let's get into it. When we make higher highs and higher lows, what is the assumption? Any 4-year-old can tell us what this is. This is a bullish trend, right? Probably not a 4-year-old, like let's say an 8-year-old, right? This is a bull trend, right? And you can tell me in 4 seconds that after a higher high, we're looking for a higher low, right? Now here's where the assumptions come into play. So you assume after a higher low, we get a higher high. And after a higher high, we assume we get a higher low. So let's say you have a trade here. Say you have a trade, right? Let's just say this price action is not known yet. So you have a long here at the higher low, then the assumption after a higher low is a higher high, right? So with certainty, you know that price will go there, therefore your take profit target will be, the highest probability, right? That's just how it is. Assumptions. After higher high, higher low. After higher high, higher low. After higher high, higher low. After higher low, the assumption is a higher high, right? Very simple. Now here's where things get quite interesting. Let's talk about failed structures, shall we? Okay. Now, under that is a failed low is bullish, and a failed high is bearish. Right? These concepts may be, you might be saying, "What the hell are you talking about?" This may be the first time you see this, right? But very important. Okay, so let's tie everything together. Higher high, higher low. Higher high. Let's say there was a structure here. That would have been your higher low. Let's say you have a structure. However, what happened? You created a lower low. Okay? Created a lower low. And manipulation happens quite frequently in the crypto market. So, okay, you accept it. Fine. Now, after a higher low, or let's say this is still a key level, we see a lower high form, right? And the assumptions alone, this will tell you that after a higher high and a higher low, what happens? You're supposed to break structure to the upside and create another higher high. However, you created a lower high and another lower low. Therefore, our bullish trend is invalidated. Right? This looks quite easy. So let's make it hard. Higher high, higher low, higher high, higher low, higher high, higher low. Ooh, what is this? Lower low, lower high, lower low. Okay, now things are getting a little tricky, huh? Let's analyze it. Higher high, higher low, higher high, higher low, higher high, higher low. Okay. So, using the assumptions, right? Using the secret sauce. What is the assumption after a higher low? Right? A higher high, right? A higher high. However, what happened? Instead, we got a failed high. So, this structure alone can tell you, okay, so we have a failed high, and based on our assumptions, we're supposed to get a higher high. Therefore, what did I say? A failed high is bearish. Okay? Let's say you don't see any of this price action just yet. We're only here. Failed high, therefore there is a high probability chance that we run this low and create a lower low. Now suddenly, our bullish trend that any 4-year-old would notice is a bullish trend has now been invalidated. So now we're starting that lower low and lower high trend, which is bearish. We're now starting the bearish trend. So we get this lower high, sorry. We get this lower high. And based on assumptions, okay, what if you had a short position here? Because you saw this failed high followed by a lower low. Based on assumptions alone, you'll be able to target this low here, as we create another lower low. Okay? Very simple. Now, inversely, after this failed high, suddenly we get a failed low. Why is it a failed low? Because it failed to create a lower low, right? Simple. Right here. What did I say? A failed low is bullish. Okay. So, if you're watching this price action and you see a failed low, it can already give you a sign as to what happens next. Which is, guess what? A higher high. Interesting. Do I want to position? Maybe. Sure. Take a long here. At the higher low. And guess what? With assumptions, the target should be a higher high, which we actually get. Right? This is how things should look like. So let's get in the charts, shall we? Okay. Let's bring in our trusty sauce. Okay. So, without strategy, without anything, let's just identify structure. Okay. So let's say we see this candle body, right? Body equals continuation. Okay. So higher high. Now this will be our higher low. This one right here. They break structure again. Higher high, higher low. Higher high, higher low. Right? Let's say you wanted to position at the high low. Let's just say you already have a target, which is a higher high, right? This would be an easy target because you know, based on assumptions, right? Based on assumptions, right? You'll be able to, guess what? You'll be able to have a valid exit target, right? So we get that. Make another higher high, and we get a higher low. Guess what? Position again. Now, can you tell me where the take profit should be? 3, 2, 1, right here. Right? We make another higher high. Right? Very, very simple way of looking at things based on assumptions. The assumption after a higher high is a higher low. Right? Nothing's linear. Things just don't go higher high forever, right? Things have to pull back. Right? So after this higher low, what's the assumption? Higher high. Okay? So here's the thing. We see this, right? Talking about candlestick anatomy. It gives you the initial clue. Okay? It gives you the initial clue. So suddenly, we break this. And now what? This bullish structure has now shifted bearish. Okay? Suddenly, you have a lower low. This lower low. After lower low, what's the assumption? Right? What's the assumption? A lower high. Okay. And now, we made another lower low. Lower low. Okay? This should be the lower high. Okay? So, can you tell me, is this a lower low? I'll give you 5 seconds. 5, 4, 3, 2, 1. No, it's not. Because we didn't break this. So now, that's what you call a failed low. Failed low. So if you were shorting, you would have stopped shorting, right? Now, what happens next? Suddenly, at this point, we broke structure here. Now we're at the higher high. Though admittedly, things are kind of choppy, right? So let's just continue. Higher high, higher low. Mind you, we still haven't broken this, so it's still valid. Higher low, higher high, higher low. What's the assumption? What's the assumption after a higher low? Right? The assumption is we create another higher high. But what happened? Did we? No, we did not. It's a failed high. Now, what again happens if you see a failed high? Is it bullish or bearish? It's bearish. And true enough, we get this massive sell-off and suddenly making new lows. However, this can give you another signal. We're making new lows, however, it's just a wick, no body. So, if you've been listening to me this far, right? If it's just a wick, is it a continuation or a reversal? Interesting. It's a reversal. And what do we get? We get a reversal. So, what now? Right? Suddenly we have a higher high. So this is the lower low. The lower low, we get a lower high here. and then we are unable to break this low, right? If this was truly a lower high, then this would have broken through, but we get a failed low over here. Uh-oh. Uh-oh. What does that mean? Failed low equals bullish. So, first sign of bullishness is here, right? We break this lower high. Now we made a higher high. What's after a higher high? A higher low. Suddenly we have a trade in our hands. You buy. Suddenly you have a trade in our hands, and suddenly, right? So now we've made another higher high all the way up here, right? Supposedly this is our higher low. Now the thing is, this is a failed high again, because based on assumptions, okay, what's our assumption? After a higher low, you're supposed to be making another high. We get a failed high and a sell-off, right? Now you can try this by yourselves, right? You can see market structures, right? In any coin that you choose. This is Ethereum. You can try Solana. You can try Bitcoin. The same thing, right? The failed high concept, the failed low concept, right? The assumptions concept, secret sauce. I suggest you guys try it on your own. I suggest you guys put this to heart, right? Put this to heart, because what I want you to do is to think of price action as a story, a narrative, right? If we make consistent higher highs and higher lows, then the bulls are winning. The bulls are in control. However, right, if we get that first sign that the bulls are not in control, like the bears are fighting back here at that failed high, they can already tell yourself, okay, maybe the bulls are losing steam and, you know, the bears may be taking over. And sure enough, it does. Right? So when you look at price action, I want you to tell me what the story is. Are bulls in control or are bears in control? Because if you know who's in control, then you would know how to position yourself. Okay? Very simple. Very, 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 very simple. Okay. So now, let's talk about market sessions. This will be the last topic for part 1, which is the foundationals. We have Asia and London, and then we have US Open, or New York Open. Same thing. Now Asia Open is roughly 8 a.m. London at 3 p.m. Let me just write it. 8 a.m. 3 p.m. and this one for the stock market open is at 9:30 p.m. Okay? So why am I telling you this? Well, back in Forex, London Open would sweep Asia and US Open would sweep London. Now, all these sessions, they'll sweep each other, right? That's in Forex. Now, the London session is not really relevant to us, but this is the most relevant because stocks are more correlated to crypto. So what happens is usually we'll see price action like this. We'll see some stalling. Let's say this is Asia to London, and sometimes during US Open, you see a sweep. That's manipulation. Remember, US Open is manipulation, usually into a key level, and then we start moving up. So something to keep in mind, If we dump into US Open, then most likely we go up. If we go up in US Open, most likely we go down. Okay? What the hell are you talking about again? Okay, let's go to the charts. Let's see exactly what I'm talking about. Okay, let's mark out Asia. Asia up until right before US Open. Okay, so US Open, we get a move up and then suddenly move down. So this move right here, this is to entice you and me, traders in general, to take some longs, only for them to manipulate you, right? Because the real move is down. Okay, so let's move on. 8 a.m. All right, here we go again. Asia to London, US Open, huge move up to entice traders again to take some longs, liquidate you, and then there's the real move, right? So what's the relevance here? Well, you kind of want to position during US Open or after the manipulation. That's what you want, right? So it doesn't always happen, but it's something to keep in mind. Let's do the same exercise. So 8 a.m. here up until 9:30. Okay. So US Open, once again, we get this push up and, the downward move, right? Let's do this again. 8 a.m. 9:30 p.m. Okay. Get this move up, and then during US Open, right? We push up during US Open, then we dump, right? So again, what is this relevance? Why is this relevant? It's because I'm telling you this so that you won't take part into the manipulation, right? You see this move up, oh my gosh, I missed this move, and then you're liquidated. You're stopped out. But then, if you listen to me, right, and you know that the US Open is where manipulation happens, and if you see a pump during US Open, you know that the real move will give you a dump. So that 9:30 gives you that crazy pump up until around 10:30, and then we just dump up until 3:30 a.m. Now we dump into a key level, right? So just set your limits, right? Or if you've positioned before that, that's absolutely fine. Just do not position right before or during the manipulation period. Okay? So, the last example for today. 8 a.m. 9:30. Oh my goodness. Guess what? Okay. 9:30 p.m. Guess what? We get a push up again. Push up, and you're telling yourself, okay, the dump is done. Fine. We're suddenly pushing up. However, if you listen to me, if you remembered this exact video, this exact session, then you'd know. It pumped before US Open. Most likely it's gonna dump, right? Sure enough. So I'll give you examples of when it does the opposite. Uh, right here. Okay. So 8 a.m. up until 9:30. Okay. Okay, here we go. So we pump into Asia London session, right? 9:30 p.m. we get this massive dump. Massive dump, massive dump. So once we get a dump during US Open, that means we are bullish. Now guess where it it dumps into? It dumps into a key level, right? So this would have been your time to, let's say you caught this at the peak of bottom, right? It's a good place to enter, right? Something like that. Again, I'm telling you this so that you won't fall victim to the manipulation, right? You could be manipulated into taking shorts here. Like, oh, here's open. Here's open weak. Okay, let's take some shorts. Okay, I'm stopped out. Why didn't I listen? Why didn't I listen that if we dump during US Open, it's bullish, and if we pump into US Open, then it's bearish, right? So that's quite simple, I guess. And that ends part one. So in the next parts, we go into the strategy proper. Okay, I'll see you in the next. All right, so now that we've laid the foundation from market structures to trading timeframes to trading sessions, you're now ready to move from understanding the market, the foundation, to actually executing these trades. So in part two, we'll dive into the core strategy, how to identify high probability setups, manage risk, and trade with discipline. Now, quick note though, if you made it this far and if everything is making sense to you and you're getting value from it, well, we do offer a private mentorship where I or one of our traders work one-on-one with you to help build real consistency. Now, I've already had 2 mentees in the past. We've done 6-week one-on-one sessions. So I do have experience. Now, the thing is, we don't just take anyone, okay? You'll have to apply, of course, and there might be a waitlist. But if you're serious about getting real help, the link to apply is below. So just check it out if ever you have time and you're interested. So let's get to the strategy. So starting it off with part two, we have break of structures, right? If you're part of the Discord or if you just see any content I put out, well, I always mention about break of structures, right? Break of structure to the upside, break of structure to the downside. Again, this is our bread and butter. Now, this ties in directly with the candlestick anatomy of part one, right? So, remember what I've said. If you guys remember, if it's just a wick, then it's a reversal. And if it's a body, it's continuation. If you guys remember that. And you should, because that's the foundation. Okay, so here I have some candles for you guys. Now, this is what you call a true break of structure, right? From this wick to this body, right? Because what we say with body, continuation, right? So BOS, or break of structure, should be the candle body, okay? This is a break of structure right here. Now, if you look here on the right side, this is not a break of structure because what is this? It's a wick. And what happens after a wick? Usually, remember, reversal happens. So, where's our X? Let's look for our X mark. There we go. This is not a break of structure. Yes, break of structure. No break of structure. Okay? Just this knowledge alone, you'll have signs. Okay, price could possibly continue higher, and here price could probably trend lower because this may be a reversal sign. Okay? So, let's get into the actual chart and let's see what I'm talking about. So, remember this break of structure should be candle body. Okay. So, here we are. So over here, in this Alve, this is Alve, by the way. So at this point, this is a break of structure, right? This is a break of structure as well, because we're creating a lower low. Okay, we broke structure to the downside, and now we're breaking structure to the upside. So it's now confirmed that this is a higher high. Okay, so here's the thing. Now I'll get back to this price action later when we talk about supply and demand, but for the sake of this particular part, let's break it down. So this is our higher low. This area is our higher low. We're getting the break of structure here, right? There's a major break of structure there. There's an internal break of structure here, right? So what this just means is that, okay, we're getting continuations, right? So we're getting a break of structure there. We're getting another break of structure here, right? Right there. See, candle body. Remember? Candle body. That's a true break of structure. Here is not a true break of structure. Wick to wick, reversal, right? Okay, very good. Simple. And then we get the true break of structure right here. So, continuations, right? We're just getting continuations. Higher, high, higher low, higher high, higher low, higher high. Same thing. Now the major break of structure is over here. Right? So, continuing the trend. So, something I just want to explain, right? There's one range from this high, from this low to this high, okay? So anything in between that is what you call internal break of structure, right? Now, the true higher high is here. The true break of structure is here. We call it the external break of structure because that's the major range that we're in, okay? So anything in between is what you call an internal break of structure, okay? So, what's the relevance of that? Now, the internal break of structure can give you clues as to where price could go before reaching the external break of structure or the external range. So, what do I mean? So here, we have an internal range here. They're like this. So we have an internal range, and we broke that range, right? We broke structure. So that's bullish price action, right? Internal higher high, okay? Internal higher low, okay? And then now that range is this. Let's clean that up a bit. Let's remove the moving average first. So now, it becomes this range, right? Are you following? So let's do that again. External break of structure. External range, okay? External range. Internal range, okay? So, we've broken that internal range, an internal break of structure, okay? So now, we're working with a new range. That new range is here, here to here. Now we've broken out of that range again. Another internal break of structure, another higher high. So now we look for, after the higher high, what's the assumption? A higher low. Okay, perfect. So now our range is from here to here. And guess what? We're breaking structure again. Now after we broke this structure, it seems like this is one whole leg, and then that's the only time we broke out of that major external break of structure, external range. Okay? So now, since this is one whole leg, let's clean it up a bit. Now the range becomes like this. Right? So now that we've broken out of this structure, this external strict structure, that's the break of structure. We broke out of that range. So now we continue, right? So we're breaking out of that range over here. So it just continues, right? Break of structure, break of structure, break of structure. And then we just create a new range, right? If you break out of it, then the new range is here. Break out of it, new range is here. Break out of it, new range is here. And similarly, if we break out of it down, the new range is here. You break down again, new range is here. Something like that. So that's a foundational concept, right? Why is it important? Because it helps us mark out our higher highs and higher lows. Right? How can there be a higher high if there is no break of structure to the upside? Right? So that's foundational concept that you guys have to understand, right? Okay, so now that we've gotten that out of the way, let's talk about supply and demand. Right? You guys always hear me say this. Oh, I'm in here at the demand zone, right? But okay, what actually is a demand zone? So let me draw the trusty candles again. Okay. All right. So break of structure. Okay. Break of structure. And this is our demand zone. It's the last candle before the impulsive move. Okay. By impulsive, I mean it leaves a gap between candles. Okay. So let's let me show you how that looks like on the chart. Okay. Right here. Right here. Okay. So remember, break of structure. Okay. Break of structure there. There's also a break of structure here. Now, the demand zone is this one because it is the last candle. Okay, let me write that down. Last candle before an impulsive move. Okay? And what's the impulsive move? It's this. These two, actually. These two. These two candles are the impulsive move. Okay? And what did I say? An impulsive move leaves a gap between this candle and this candle. Okay? That is the gap. Okay? Now, this is what you call a fair value gap. Fair value gap. Okay? Okay. So, here's the thing. Now that we know these two things, let me give you guys the secret sauce. So, the criteria for checking for a supply or a demand, we have three. One, valid break of structure. Okay? Two, leaves an FVG, leaves a fair value gap, meaning that's impulsive. And three, obviously, context, right? If we're in a bullish trend, then we pay attention to demands. But if we're in a bearish trend, we pay attention to supply zones, right? So you have to pay attention to the context, right? If we are in a bullish trend, here's how you think of it. If we're in a bullish trend, we look for longs, therefore demand. If we're in a bearish trend, we look for shorts, therefore supply, right? That's how you do it. In a bearish trend, you don't look for longs, right? So we don't really want to pay attention to the demand zones. Okay, that's something to keep in mind. Okay, so always write this down whenever you're about to have a trade. Okay, always write this down. Now, here we go. Valid break of structure. Check. Okay, leaves a fair value gap. Check. Okay, context. What is the context? Okay, you can tell me in 5 seconds that we're bullish. Okay, very good. We are bullish. Okay, so here we go. Now, how do we position? This is a demand zone. We put our long position here. Okay, give it a few leeway for sweeps. And what's the assumption? What is the assumption? Tell me now. The assumption is that we get a higher high, right? Tie it all together. Tie it all together. So your entry is here at the demand zone. Your SL should be right below it. Okay? If you want to be super sure about your invalidations, then it can be right here, because we know if we break this, then that's for sure bearish, right? But you know me, I like to be cute. I want a better risk to reward, so I just do it like this. Okay, check, check. Now context, obviously we're bullish, so check. Simple as that. This is how my trades go. Boom. Okay, what now? Now, we're looking for another break of structure. Look at this. There's a break of structure here. Beautiful. Okay. So what caused that break of structure? This demand zone. Okay, this demand zone. Now, valid break of structure. Check. Leaves a fair value gap. Where is our fair value gap? From this candle to this candle. Boom, boom, boom. Equals impulsive. Check. Check here. Check here. Context. Can you tell me if we're bullish or bearish? 3, 2, 1. We are bullish, right? We continue to make higher highs and higher lows. Therefore, check. Okay? Very simple. That's why before any single trade that you take, bring this out. Bring it out. Put it on a post-it, a sticky note. Stick it on your wall. Criteria 1, 2, and 3. Before doing anything in life, before you do any chart, whatever, bring this out. Because if one of these is an X, then it drastically brings down your probability of success. Okay? All right. So, what did I say? Here. Entry at the demand. your SL right below, TP at another higher high, assumptions, assumptions, assumptions. Boom. TP hit. Now, here's the thing. The same strategy that you did here. Let's apply that again. Break of structure, demand zone, last candle before that impulsive move. There's a fair value gap, and we took an L. Okay, so what? Now we reassess. Okay, we're taking L's here. What are we looking at? Price could go lower, sure. But at this point in time, we just wait. We don't know what price is going to do. Wait for the next opportunity. That's fine. We take the L like a man. Right? Here's the thing. If you don't know how to take L's like a man, then you do not know how to take W's like a man as well. If you take W's and you think you're a god, then that's not how to trade. If you take L's and you think you're the worst trader on the planet, that is not how to think. Okay? So, think of it as a numbers game. Win, win, lose. Right? But in risk to reward terms, 3 plus 1.6, that's 4.6. Minus 1, that's 3.6. You're still up 3.6. Right? So one loss will not define you. Okay? We'll get into psychology later on. But that's just something that you have to keep in mind. Okay? So, where is price going? Price seems to gravitate towards this demand zone. So, for us to target lower, then we kind of want to see a candle body close below that. Okay, interesting. Now what? Now, we're seeing price break structure, right? It's breaking structure. Okay? So possibly it just wanted to trap traders and go back to this demand zone. Okay, fine. Cute. We're being cute here. Okay. So, criteria. I see a demand zone here. Criteria. Bad break of structure? Yes, sir. Leaves a fair value gap. Yes, 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 it did. Okay? Context. Context, we're still bullish. So, I would take this trade, and I took this trade. I gave this as a signal. So, to the community members, I gave this as a signal. Okay? So, here we go. Entry at the demand. SL, give it a little bit of sweep insurance. Okay? And where's the take profit? Right at the higher high. Boom. Okay? Very good. Very, very good. Now, 6 risk to reward, 6%. Now, if you did not take this loss well, you would not have executed this trade. Simple. Okay. So, we are breaking structure here. Okay. This is a massive, 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 massive move. So, break of structure point. One here and one here. Caused by this demand zone, right? Last candle before that impulsive move. Okay? Criteria, bring it up. Okay. Value break of structure, check. Use a fair value gap. The biggest fair value gap you ever seen. Beautiful. Context, very much bullish. Therefore, we take this trade. And once again, we take this L like a man. Now here's the thing, right? Depending on how you manage this trade, it's going to be like this. So, we're still in profits here. Alright? Now, you may probably think, okay, if price goes back to my entry after these explosive moves, then probably I might get stopped out. Probably. Right? So you may set it to break even, or you may take the L like a man. Doesn't matter. It just depends on preference, right? If you set break evens, then you'd probably break even and you wouldn't get in this trade. Same with this. It went up, it went back to entry, and then took profit. So depends on you how you manage your trade. Honestly, I don't like going break even because I might miss some trades like this, but it saves you from losses. But the thing is, right? You're safe from one loss here, but you miss out on these gains. So, that's the trade-off. You do you. Uh, yeah, you do you. Me personally, I don't like break even, so I would take this L like a man. Now here's the thing. Okay, what is price doing? What the hell is happening here? So this is when you can finally say, finally say that okay, we are seemingly bearish, breaking this structure. We're breaking structure to the downside. Okay, we even broke this major structure. Okay, so now I'm thinking, what happened here? What resistance level did we seem to cross? So looking at the daily here, something looks interesting, Something looks quite interesting. There is a supply zone right there. Okay, there is a supply zone right there. Right there. So supply zone is the opposite of a demand zone, right? It pushes price down. It's the last candle before that impulsive move down. Criteria, valid break of structure, valid break of structure, fair value gap. There is a gap here. Very good. Context. Well, the context here is a downtrend, but the context going up is a bull trend. So I would not have acted on this, but it's just there as a guide. It's a guide for take profits, or it's a guide to expect, a reaction from. Similarly to how you would mark out resistance levels, right? Resistance levels are areas where price could bring price down. Same thing with supply zone. Now here's the thing. We got that sweep, right? Remember how wick to wick equals reversal? We got it, right? We got it. So it caused this huge move down, and we took that L like a man. That's just how it is. We took that L like a man. Now, okay, here's the thing. After taking that L like a man, we're suddenly V-shaped reversal. Okay? Now, I won't touch the moving averages just yet, but I'll tell you right now, if your moving average, okay, and I took this trade live for you guys, okay, I gave this as a signal. So, if the moving average and the demand zone coincide with each other, then that's double confluence. Therefore, that is the highest probability trade you could ever take. Okay? Very good. Now, we see a break of structure. Okay? We break above the moving average and a break of structure. Okay? So, why did I take this? Because I like to be cute with my risk rewards. That's all. I could get front ran. Okay? If you refine your demand zones too much, you can get front ran. Okay? That's a real possibility. So the real demand zone is this one. Right here. So, where's my trusty text box? Alright, here we go. Now these are all trades that I took. So, let's get to that later. Okay. Criteria, valid break of structure, Yes, sir. Leaves a fair value gap. Yes, sir. Okay? Yes, sir. Context? Tricky. Okay? Let's walk through it. Context is we broke structure to the downside, very, very strong sell-off below moving average. However, quickly absorb. And suddenly we're back above, the moving average, and we've broken structure. Therefore, check, check, check. Okay, very good. Now, it could be like this, like risk reward 1.82, but me, I'm cute. I got cute here, and I use this, so it bumped up my risk reward to 2.64, and my invalidation was this. Right, that was my invalidation. So we got it right there. Next, here we go. Break of structure. Okay, break of structure. This is our demand zone. Check, check, check. Where's my trusty text box? Okay, valid break of structure. Hell yes. Leaves a fair value gap right here. Yes, sir. Context. Okay. Now we are now creating higher highs and higher lows. Therefore, we're back to being bullish. Okay. Boom, boom, boom. Demand. TP right at the higher high. Okay. Very, very good. Now. Okay. Now. Here's where things get a little bit spicy for me. Okay. Let me just explain my trades to you guys because, I'm a risk reward maxi. So when you see a price like this, right? Possibly this could get taken out. So that was my assumption, that we create a higher high on the external structure. Okay. So right here, this is our demand zone caused by this break of structure. Very good. Now, one cheat code that you guys can do is you can wait for price to go back to your demand zone, and you can try to get in at a lower point, which is what I did. Okay. Now, you got a break of structure there. There's a demand zone here. So this is also a good entry. So criteria, check, check, check. Criteria, check, check, check. And here's where I double down on my entry. So it went back to my entry twice, but then we see it's still at our demand zone. Okay. So instead of risking 1%, I brought it to 3%, and this trade alone got me 7 risk to reward times 3. That's 21% of my account. Right? Live, I gave this as a signal to everybody. So that's how to do it. Right? Okay. So now that we've broken out of major structure, so here we are. Another demand zone for you guys. TPing again at higher high. See how simple this strategy is? And you see how the foundation is on market structures and break of structure, right? Very simple. Very, very simple. Okay, so what I want you guys to do, I want you guys to pick a coin. Okay, pick a coin and just do what I do. Mark it out. Okay, mark out the break of structures, the demand zones, right? Make sure you have this trusty text box right here. And before you do anything, always try to answer the 3 criteria, right? Is it a valid break of structure? Check. Does it leave a fair value gap? Check. Context-wise, am I really bullish or am I trading against the trend? Right? Am I pro-trend? Pro-trend meaning in a bullish trend, you are taking longs. not shorts. Okay, that's pro trend. And on a downtrend, you'll be taking shorts. That's pro trend. But inversely, if it's a bull trend and you're taking shorts, and if it's a bear trend and you're taking longs, that is counter trend, right? So context is very much needed. So break of structure, fair value gap, and context. Now that's for our supply and demand plus fair value gap. Okay. So the next one will be about moving averages. All right. So now let's talk about the 200 moving averages. All right. So how do we set it up? So type EMA slash SMA, and this will pop up, right? So we have this drop box here. We have only set the EMA 4, which is 200, and SMA 5, which is 200. Okay. We don't like the 50, the 30, the 50, right? Mainly because the moves that you capture from it are just way too lower time frame, right? It's just too low of a time frame. I like to catch, the bigger moves. So I'm sticking with the 200. Okay. So fundamentally, the 200 moving averages, they just tell you one thing, right? The overall trend. Okay. So in Investopedia, obviously, they're going to tell you, okay, if it's above, it's bullish. And if it's below, it's bearish. Yeah, we know that, right? We know that. So how do we use this as a tool for our arsenal, right? So what we'd want to do is to look for the time frames that are lucrative for that specific coin, right? So I'm gonna be saying this throughout the video that you have to find that exact time frame that respects your coin. Okay? So some coins respect the 4 hour more, some coins respect the 2 hour, the 3 hour, 1 hour, 30 minute, whatever. It's your job as a trader to adapt and to be able to identify that exact time frame. Okay, let's begin. So as we can see here, this is the 4 hour moving average on Aave. So we see a flip here, right? We're continuing the trend, and we get a flip here. Now we have a breakdown into V shape into a break of structure. Now there is a juicy demand zone over here, right? So demand zone because broke structure, valid break of structure. Remember our criteria: valid break of structure, fair value gap, context is we're bullish now. But me, I like to be cute and try to keep my risk to reward as tight as possible. So this is my entry. But either entry you can use, right? Just depends on your risk appetite. Okay. So I actually, yep, there we go. So this was on the 3 hour where I actually sent this trade in the Discord, for everyone to take with me. It's a signal. And if you were there, you'd actually have a better entry than me because I actually sent this when we were still dumping, right? So let's look at it here. So on the 3 hour, it tells you the same story, right? Right at the moving average. So when a demand zone, or a supply zone for that matter, falls right at the moving average, then your trade suddenly becomes exponentially more probabilistic, right? So it's just more likely for you to win. That's all. So if the two confluences align with each other, there's a higher probability of you winning. Okay, that's it. Now, this is what I sent in the 3 hour on the Discord. So if you were there, you'd be able to take this win. Remember, higher high, higher low, assumption, higher high. right? So again, very simple way of trading, very high probability. Now, if you're not in the Discord yet, right? If you're not in the Discord yet and you want to be able to take part into what I send you guys, I send market outlooks, I send my positions, everything, what I expect price to do. So if you want to be part of the inner circle, right, just click on the link in the description or in the comment section, apply for it, and we'll get back to you, right? And another thing, if you like the way I trade, well, you've gotten this far already. If you like the way I trade, you can also set up for the mentorship. We do one-on-one where I teach you guys, right? Depends on how many weeks you guys want it, but it's gonna be a one-on-one mentorship session. So just sign up in the description or the comment section below, and we'll check the waitlist, right? So that's it. Let's move on. So how I like to use the moving averages is, let's say, the 4-hour. Now, how do we capitalize on this if you missed the initial move? So what you want to do is to go down to the time frame that lets you catch something like this, right? So what we do is we go down time frames. So if it's not the 4-hour, maybe it's a 3-hour. Yes, it is. It is actually the 3-hour. So if you look here, there is a demand zone right here sitting, guess what? Right at the moving averages again. So that's something you can, boom. That's how your entry would look like, right? So let's say, let's just fast forward it a bit. And once you see price exponentially expand away from your moving average, so for this example, it's the 3-hour, then you'll have to find a more suitable time frame that acts as dynamic support, right? So what is that? If it's not the 3-hour, is it the 2-hour? Nope. The 1-hour? Oh, we're getting there. 30 minutes? 30 minutes. Okay. So we have opportunities here, 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 right? We're basically trading within the 30 minutes. Okay, so how do we make use of that? So what you want to do again is we go to our 4-hour, look for demand zones. So I found one right here. So there is a break of structure right here, break of structure. So now we ask ourselves, okay, is this 4-hour demand encompassing a moving average? Yes, it is. Like right there. So this would have been quite a beautiful entry as well, right? Right there. See? So on the 4-hour, it's a valid demand zone, and on the 30-minute, it's sitting right at the moving average. Okay, so looking forward, I see a demand zone here again. I see a demand zone here as well, and I see a demand zone here. Now let's go down to that exact time frame if we can find some confluences. So what we can see here, right? Sitting very near that moving average, right? Very near. So that's also possible. This is also that 4-hour demand that we were talking about. Boom. Absolutely beautiful as well. Almost tapping it, right? Here, this is a 4-hour demand. Again, tapping it. So that's how to use it, right? That's how to use the moving averages with, your demand zones. So the highest probability trades will be if you use it in conjunction with the demand zones. Okay? So if you're too fixated on the 4 hour, and right, you probably would have missed this. Right? Oh, I'm just gonna wait for it to go back to my moving average. Oh, don't worry about it. I'll just wait. And you miss this whole move when you can easily just go down time frames and use it in conjunction. So now your 4 hour demand, suddenly those longs look very attractive because they're still following that dynamic support moving average, right? So something to keep in mind. Now, once we lose that exact moving average that helped us get all those gains, maybe it's time to get out of the market. So we're now using it as resistance, and we've sold off ever since. Okay? Let's move on. Fartcoin. So over here, we flip, right? We flip the moving average here. So now we're very bullish. So if we use the demand zone, pretty good. Okay. So we get another break of structure. Beautiful. And if you can see here closely, what is this? This 4 hour demand zone sits right at, guess what? Right at the moving average. Now, what if I told you I sent it ahead of time? What is this? May 9 or 8, I think. I gave this as a signal for the Discord, my Discord channel followers, and instant 8.42 RR trade, right? Very simple. Again, confluence. When used together, it's very powerful. Very powerful. Okay? So, again, if you haven't signed up for the Discord, check it out in the description below. And if you like how I think, if you like how I do things, right, and you want to learn exactly how I do it, well, very simple. Just sign up on the description below, and we'll have a look. Okay. Let's move on. Here we go. So let's remove that first. Let's get down to the analysis. Okay. So SPX, okay, we got a flip here, and we're breaking structure. Over here, the most ideal, long would be in this 4 hour demand zone. However, we just don't get it. So next stop, we have this break of structure followed by this demand zone. So this looks like an entry to me already. Okay, so maybe I'll ask myself, where could, what time frame can the moving average be in my favor? Let's see. 4 hour, nope. 3 hour, nope. 2, not really, probably just now. 1 hour, boom, there we go. That's exactly. So touch. Next, we get that tap exactly right at the tick. So that tells me, this alone tells me, okay, so XPX wants to follow the 1 hour demand, 1 hour moving average. So let's use it. Now, this is the 4 hour demand zone, mind you, and there is a moving average right below. So that's where our stops would be, right? Below the moving average, and it barely touches it, sweeps it a bit, and we get our take profit. See how very, very easy. Now, what is this? It seems like, once again, I have showed this in the Discord before it actually happened, right? How about that? This is the entry, and boom. I shared it here even before the sweep, so you could probably get in at a better entry than me, right? So very simple way of trading. Very simple way. So let's go down to the last one. Solana. All right. So, oops. So here, let's top down analysis this for a while. So we're basically chaining demand zones, demand zones. Perfect. So now that price is in this demand zone, price is in this demand zone, okay? I'd see where I could take some continuations from. So I see a 1 hour demand zone right here that I'd like to bid. Right there. That I'd like to bid. Now, I'll ask myself, the 1 hour isn't acting so much as a dynamic support. So, and the 4 hour is extremely far away. So, what can we do? Let's go down. 45 minutes? Not so. 30 minutes? We're getting there. We're really getting there. 15? Bingo. So, again, this is just me reiterating how every coin is different, right? Every coin is different. Aave, we use the 30-minute. SPX, we use the 1 hour. Fartcoin, we use the 4 hour, right? But the concept remains the same. You find a demand zone that matters. Demand zones always take priority, okay? And the next step is to look for moving averages that match or that does give you confluence, right? So this was a 1 hour demand zone followed by, guess what? Beautiful, beautiful taps from the moving average. So once again, what is this? Once again, I showed this to you guys, right? I showed this to you guys in the Discord as a signal before anything even happened, right? And guess what? We woke up in profits. Take profit. We woke up in take profit already. See? So that's just how to do it, right? Again, wanna join? Head over to the link, right? If you like how I trade, wanna know how to do it? Again, it's all there. It's all in the link. So now what I want you guys to do as your little assignment, right? If you're watching this, well, go to your favorite coins, right? Bitcoin, Sui, BNB, whatever it may be, right? Try to find that exact time frame that uses, the moving average as the dynamic support, right? So that's my advice for you guys, because every coin is different. And I've showed it to you guys pretty perfectly how every coin is biased to a different time frame, right? So I'll see you in the next. So part 3, let's talk about psychology, right? Let's talk about psychology. Now, you probably may think, why the hell am I talking about psychology? Like, who cares? Who cares about psychology, right? Well, let me tell you. You know the strategy, sure. Supply and demand, sure. Market structures, higher highs, higher lows, you know all of that. Sure. Yeah. Okay. I know how to execute my trades. I showed you how to execute your trades. I showed you where to put your entry, your SL, your take profits. Okay. Now here's the thing. What if, what if it was you had a bad day? Okay? Bad day at work? your boss, you know, you underperformed a bit and your boss gave you hell. You're a student and your professor gave you hell. Or you failed an exam and suddenly you're not at your best mind. Right? You're not at your best mindset. You're kind of down. Now, can you tell me 100% that you'll be optimized for your next trade? Right? Can you honestly tell me? So what if you have a 50% win rate at 100% performance? Okay? Imagine this. 50% win rate, 100% performance. You're feeling yourself, you're confident, right? You're feeling good, you're doing good. So you're profitable. 50% win rate is profitable, especially, if you see our trades here, risk to reward is 2, 3, 4, 5, sometimes 6, right? That is profitable, okay? Now, what if you had a bad day? You had a bad day, right? Your boss gave you hell, or you fought with your partner, right? Life isn't 100% the best all the time, right? That's something to keep in mind. I mean, we're human. Like even I go through bad days. So, at 60% performance, what could be your win rate? Let's say your win rate drops down to just 20%. Now, keep in mind, 20% win rate, you need a 5 risk to reward to maintain profitability. Okay? So, what do? You either increase your win rate or you increase your performance level. What do I mean by this? On days where you feel bad, suddenly you're revenge trading, you're tilting, and you're not taking the trades that you should have been taking. That obviously affects your win rate, right? So there are only two ways to do this: increase your win rate or increase your performance, right? And the easiest thing to do is to increase your performance. Set of rules, the criteria that I've been advocating for, right? The three criteria. Now, how do we increase performance? That's where psychology comes into play, right? Your mental capacity, your mental health, your fear, your FOMO, your revenge trading, your tilt. That's something you should keep in check, because if you do not, if you do not self-examine, then that will be your ruin. Suddenly, one day you're at 5% win rate because you're unable to regulate yourself, to self-regulate, to you know, self-realize, self-reflect. Suddenly you're at 20% performance and you're at 5% win rate. And 5% win rate is very low. That's not good. Your risk of ruin of your account is significantly higher, right? So our goal is to be at this particular point, right? That's our goal. Obviously, you can't avoid this, but you can minimize it, okay? So, what the hell are you talking about, right? Let me ask me this. So, let's bring out our calculator, shall we? Okay. So, let's calculate all of our risk to reward. And because this is the percentage gain, 3%, 1.65. Then if you lose, it's minus 1%. All right. So, let's just calculate it very quickly. 3 plus 1.65, okay, minus 1 plus 6. We lost here, minus 1 plus 2.6 plus 3, okay, Doing good. +7 and +2. So that puts us at a whopping 23% account gain in a span of, what is this? 2 months, guys. 2 months. Now, this is at 100% performance because we've executed based on our rules. Everything has been executed perfectly. So our win rate is higher than 50% even. So when you have 2 losses and a lot more wins. Now, here is where things get interesting. Okay, so you execute like a robot whenever it pops up, sure. But we're human and we don't always see what we need to see. And in hindsight, this is obviously the best. But then, let's say you don't always work in our best, our best selves. So let me give an example. A very, very good example. Okay, look at this. Oh my goodness, I got stopped out and what was it? I just got swept and now we're trading above my entry. Oh my god, what happened here? The market maker hates me. I'm a shit trader. I'm just gonna get in. I'm gonna get in again. And okay, you lose again. Right? You lose again. Okay, that's fine. Lose again. That's absolutely fine. Now, can you tell me after 2 consecutive losses, you tell yourself, damn, I shouldn't have entered that trade. I should have just taken that L like a man. Right? Now you're down 2%. Right? Suddenly you're down 2%. And how am I gonna capitalize on the next win? Suddenly, look at this. You missed this move. I mean, there isn't much to do here. Like I personally would have gotten after this move was done on the pullback. But what if you got FOMO? Like you're like, oh my goodness, look at this. It's back to my original entry, like right here, back to my original entry. Oh my god, what if I just held this with no stop loss? See, this is your mind playing tricks on you, right? Self sabotage. Okay. Oh my god, we're back at entry. I'm gonna enter again. You take the loss. And in hindsight, this does not look like a good trade. You're down 3%. Look at this. I see a demand zone. Possible. Oh my god. I'm done trading. I don't want to trade anymore. I'm down 4%. I don't want to trade anymore. My gains here 3 plus 1.6. Suddenly you're back to break even and I don't want to trade anymore. So this is devastating for your mind. Now, when the time comes for you to execute, you don't take this trade. Let's say you didn't take this trade. You didn't take it because you're too scared now. So that 6 RR trade that would have set you in profits, right? Suddenly you didn't take the trade and you're stuck in break even. And then guess what? You lose again. So now you're in the negative. So now you're losing your mind. You're kind of losing it here. Taking some bad trades now. Oh my goodness. Probably the bottom. They tell me to buy the dip. Probably the bottom. Don't worry. We're bottoming out here. Don't worry about it. We're bottoming out. Oh my goodness, we're bottoming out. And then guess what? It's suddenly trading above your stop losses. And you're like, oh my goodness, I should have just held again. And okay. I need to make up for my losses. I need to make up. I need to make up. I need to make up. And then you stop lot again. Right? So this is what I'm saying. This is how you can mess up a perfectly good system. So you haven't won a single thing in that span. 1, 2, 3, 4, 5, 6, 7, 8. 8 losses in a row because you were too scared to get in here. And I'm pretty sure you'll be scared to get in here as well because you're like, oh my goodness, I'm going to get stopped out again. Right? So, can you really tell me? Can you tell me that you'll be at 100% performance at all times? Right? Can you tell me? Probably not. Because I'm not always 100% performance. But here's one thing for sure. I can tell you that I don't let my losses define me. Okay? So, what are we talking about? You took this L and you took it like a man. You told yourself, it's a numbers game. I'm bound to lose eventually. I won twice, I lost once. It's not that I'm a shit trader. It's just the law of numbers. You take this trade, you win. You take this trade, you lose. Let's say you revenge traded twice. Let's just say you revenge traded twice. So okay, I'm on a 3-lose streak. Maybe I have to reevaluate my life. I need to self-reflect. I'm gonna take a day off to reflect on my feelings. You executed well again, and now you're back in profit, right? So let's compute that again. 3 plus 1.6, 4.6 minus 1, 3.6 plus 6.2. Let's say that's 10. 10 minus 3, 7%. And 2.5 plus 3, 5.5 plus 7. You're up 12% again. So I'm not telling you guys to trade perfectly all the time. That is the most ideal scenario. But what I'm telling you guys is to minimize tilt, minimize revenge trading. Okay? What you need to do is to accept losses. Accept that you're gonna lose. Nobody wins 100% of the time. Right? Nobody does. So it's just a matter of, are my wins bigger than my losses? That's what you need to think about. And judging from our strategy, it is. We are profitable over a long period of time. And our wins very much outperform our losses. Okay? So here's one thing that I need you guys to think about. 1. Accept the losses. Embrace it even. Learn from them. They do not define us. Okay? So, you're not a shit trader if you lose, but inversely, you are not a god if you always win. Okay? That god complex mindset is what gives you the overconfidence to, overbid. Suddenly you're bidding 10% of your account, you lose that and you're back to square one, right? It works both ways. Accept the losses, and inversely, your wins also do not define you. Your system does, right? Your strategy does. 2, we are profitable over a long period of time, right? People always want to get rich quick, too quick, that they over risk. Now, us, in a perfect scenario, we got 23% in a span of 2 months. This is considerably easy mode, right? And if you had a few tilt trades along the way, right, because you're not always 100%, well, the conservative account gain could be at 15 to 18%, which is still big. Still big. $100,000 account, that's 15 to 18K. That's big. Okay. Lastly, opportunity is abundant. Okay? If you keep this in your minds, then you'll avoid FOMO. And if you avoid FOMO, you avoid tilt. everything. With this in mind, opportunity is abundant. Okay? I want you guys to study this and put this to heart, all right? Because nothing, and I mean nothing, none of what I teach you is gonna work if you let your brain, your mind, if you let it destroy you. Okay? So, like I've said, 50% strategy, 50% psychology. Okay? If you're lacking that 50%, if you lack the psychology, the 50% part of the equation, the strategy, will not be able to propel your account. Okay? You need that psychology. You need this. So, I admit it comes with experience. Yeah. You have to take a few losses along your career. And that's fine. Right? I have almost zeroed out quite a while. Quite many times. Back long time ago, right? I would trade up and down. My account would go up and then almost zero and then up again and almost zero because of this. Because my psychology was weak, but my strategy was correct, right? Once I fixed my psychology, everything followed. Okay? You can sleep at night, right? Imagine if you're mad the whole week. You won't be able to sleep. You won't be able to function. Okay? So keep that in mind. And I'll see you on the next. Right? The next will be trading on ByBit. How to place the trades on ByBit. Okay? So I'll see you in the next. Right. So for the last part of this video, right, let's talk about actual, trade execution on ByBit. Well, I use ByBit. The Discord, I think the Discord uses ByBit as well. So if you don't have a ByBit account just yet, well, check the description or somewhere in the comments, and you can, sign up using the link in the description. Okay. So how do we do this? Okay. So let's go to the trading view chart, because we can't trade directly on trading view. Okay. So let's say this trade didn't play out yet. So here's what you want to do, right? Copy paste the entry price. Go to Solana here. Make sure to click on Solana here. Price, just copy price 178, right? So for this specific account, I have $50,000. So the rule of thumb is you only risk 1%, which is 500. Okay. So make sure to click on TPSL. Now go back here, click on the stop level. Okay. All right. So at this point, you can see the expected loss, right? So what you want to do here is, since 1% of 50,000 is 500, you have to make sure to make your position size, okay, the amount should be this 54,364. And when your stop loss gets hit, you only lose 526, right? That's how to do it. Okay. Then the take profit is 184. There. So the estimated profit is 1,894. And the risk is only 526. Okay. So click on the long, limit buy. And there you go. You'll see it right here below. And then you can display price, and there you go, right? So simple as that, very easy. Now here's one thing to take note of, okay? Sol USD, it should be using a trading view. You should be using the ByBit chart, okay? So I'll give you an example. Sol USDT spot, right? ByBit. Okay. Right here you can see Sol USDT perpetual contract ByBit. So it has to be ByBit. Okay. So if you look at Ethereum, ByBit. Okay. Bitcoin, ByBit. So it has to be ByBit at all times because if you choose Binance but you're trading in ByBit, then the values are obviously going to be different, right? So that's something to keep in mind. So yeah, that's it for now. I hope this video gave you clarity. You know, I hope it gave you guys actual foundational knowledge and not just more noise. Now, if it helped you, see trading in a more structured way, right? I gave you my particular system. I gave you exactly what I look at, my criteria, you know, what makes a good trade, what makes not a good trade, right? How to use the confluences all together, right? Then if I gave you that knowledge, if it helped you even 1%, then I'm happy that this video reached you. Now, if you want more than just this free content, right? And you feel like you need actual help from me or any of the traders in Discord, well, we offer, once again, a one-on-one mentorship program where we work with you directly to help you become a more consistently profitable trader. Now, like I've said previously, you do have to apply. Okay, you do have to apply. We don't just take anyone. We try to get the most dedicated and consistent traders. So there will be a wait list. Okay. So if you're serious about trading it with structure and confidence, well, check the link below. We'll look at it and we'll get back to you if we see like you're a fit. Okay. I'll see you in the next.